in commodity costs. And those cost concerns, according to economists, are intensifying because of the ongoing trade tensions with Canada and with China. So if rising prices continue to be a part of a bigger trend, how do you inflation protect your portfolios? Joining us with some ideas tonight, Ken Mahoney, the president of Mahoney Asset Management. Good to see you again. Welcome
Good to see you
back.
again, Bill and Sue.
Obviously, as inflation goes up, rates go up, and that's
Yes.
bad for bond holdings. But you advocate floating rate funds. Tell us about one that you like.
Yeah, there's different floating rate funds. So the American Beacon floating rate fund, that doesn't lock in like the other bond funds. So it keeps adjusting its rates. The portfolio manager happens to keep shorter maturities and kind of keeps up with that. So you don't have this, basically getting 3% and losing 4 or 5% in net asset value. We've seen in the last few years, according to Morningstar, that's one of the best floating rate funds there are out there.
They have a decent income?
Yeah, it's almost about 5% dividend. But the biggest thing is some protection against rising rates. In fact, if inflation's increasing, commodity prices, we just heard Procter & Gamble, passing on to their prices.
Right.
And again, a company that will be higher rates. If we have higher rates for bondholders that are looking for income, they really have to start looking at some floating rates in their portfolios.
You also say some of the big banks you might want to look at.
Yeah.
And you point out J.P. Morgan, but as interest rates go up, the banks make more money. So.
Yeah, the spreads are there. Jamie Dimon, the CEO of the concerned J.P. Morgan, definitely gets it. Their dividend's about 2%. They have a lot more. They can actually raise their dividend between the earnings per share and what the dividends pay out. But Jamie Dimon, the CEO of J.P. Morgan, if you're going to invest in a bank, invest where the best management is. And to me, that'd be J.P. Morgan.
Healthcare is a classic defensive play.
Yes.
in most cases. And you pick United Healthcare in that category.
Yeah,
Why?
I think it's an all-weather type of stock. So whether we go into recession, which I hope is not in the cards, or we ramp up this inflation type of process, that's kind of a fund also, a stock that pays about 2% dividend, also has great management, and they also could hint, raise their dividend based on the earnings per share versus what they're paying out to shareholders.
That sector, though, I mean, night after night, we seem to be doing stories about how healthcare is changing, whether you're talking about the pharmacy benefit managers or the insurance companies. You're not worried about investing in that particular sector right now, or is United Healthcare unique?
I think it's somewhat unique. If you look at the earnings report for the second quarter, which ended June 30th, they had a great quarter, and they guided higher. So the companies like J.P. Morgan I just mentioned and any other type of companies see what they just reported and what they're saying for the guidance going forward, and both of them are really positive.
Ken Mahoney of Mahoney Asset Management. Always good to see you. Thanks again for joining us tonight.